Welcome to the live stream. Yes, this is a live stream. It's called Be the Boss of Your Money. It's, I would say, the end goal here. A few things. We want you to think more clearly and deeply about how to react, how to pay attention. Yeah, that's right. Not just to pay attention, but how to pay attention to market events, economic events, political events, geopolitical events. All of these things are important. They all are, I like to look at it as they're all designed to conspire to throw you off your game. And I would say that if you get anything out of watching this live stream, it's that your best action in so many cases is no action. But that's hard to do. We are designed as human beings with two reactions in mind: fight or flight. We're not designed to just sit and do nothing. And that is exactly what this show is about. You can do it. We can all do it. But you just need to constantly be conditioned, reconditioned. And you need an accountability partner. That's me, by the way. Okay. Because reacting, overreacting, underreacting, when new news comes out, generally speaking, our reactions are almost always wrong. And we do silly things. You know, we could say we do dumb things. We sell when we shouldn't be selling. I'm talking about investments. We put money into places that we have no business putting money into because of a lack of our own knowledge or lack of experience, or just because of FOMO, fear of missing out. These are the things that I want to prevent you from doing. But ultimately, this is all about helping you get ready for retirement and stay in retirement, and potentially maximizing how you utilize all of your resources. And there's resources that go above and beyond just money. Some resources are about converting an IRA to a Roth IRA, for example. That's a resource. That's a knowledge-based resource, but it's something that you might not have thought about. It's something that might even be bad for you. So sometimes people ask me about that, and I have to explain why it's a bad decision. And sometimes I have to say it's a good decision. There are so many things to consider. So we're going to talk about a few of those things, but that's what the point of the show is. But what I want to do now is get into a little bit about interest rates. Damned if they go up, damned if they go down. We find ourselves right now in a tough time. You know that expression I use, diversification, is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And boy, oh boy, that is very true right now. So let's roll the intro. It's nice to go into this for almost 4 minutes and then roll the intro. But we're going to do that, and we're going to be off because the things we're going to talk about don't really take a lot of time, but they're important. So here we go. All right, interest rates. This rally that we've seen so far this year in the stock market has been predicated that the Fed is basically done with its job of raising rates. And then every now and then we see some economic statistics that point to prices still going higher, prices being sticky. We get an ISM services number today that was much stronger than expected. We get an uptick in the manufacturing sector today. And all of a sudden now we're back to thinking the Fed's not done, prices are going up, and it hurts the market. And we go from one extreme of bullishness, Fed's done raising rates, they could cut rates next year, stock market reacts positively. And then we go back to thinking the Fed's not done, inflation is not done going up. And then we go to worrying about the other extreme that, well, maybe if inflation could go down, what happens to the economy? Right now, from a statistical point, and I know not everybody is benefiting from the economy. There's always people who are struggling, always people who are thriving. But on the aggregate, economic statistics do not in any way, shape, or form point to a recession. Now, some soothsayers are saying that we haven't seen the full impact of all of the Federal Reserve's interest rate hikes over the last year and a half. We will feel those, and as we feel those, that will slow down the economy. The consumer is getting tapped. Stimulus money has been spent. Credit card debt is at a record high. And by the way, in every bubble, it's tough to say if we're in a bubble or not. You don't know for sure until after they pop. This is why people lose money. But let's just talk about a bear market or a bad economy, recession. There's always something that gets overcooked. It could be, mortgages in 2007, 2008, tech stocks in the year 2000. And right now you could say the next big bubble, if you will, is credit card debt. And that's an indication of consumer stress. It's an indication of too much debt. And with interest rates pretty high right now, carrying consumer debt, credit card debt, is a lot. You see how much more money a car costs for the same price, but with a higher rate, cars cost a lot more money. Houses cost a lot more money. Rent, as a result, costs more money. And because of inflation, everything has to go up in price. So your real estate taxes have to go up because prices are going up that the county, that the schools are paying. So everything is going up. The Federal Reserve is trying to arrest that. I don't know if the Federal Reserve is as potent of a inflation killer as people think. So this is a little off topic, but Paul Volcker was Federal Reserve chair, appointed by Ronald Reagan. He jacked up interest rates in 80 and 81. I think mortgage rates were like 15 to 16%. Treasuries were paying 13 or 14%. And he put the economy into a pretty nasty recession into 82. But some other things happened. But the point is, inflation went down. They say Paul Volcker, at the Fed chairman at the time, killed inflation. And that is what allowed a very steady but low inflation rate to help propel the economy, our society as a whole, the stock market, for the next 40 years. But something else happened, and I don't think the Fed deserves as much credit as it's given. In 1980-81 is when offices started using personal computers. And this ushered in a massive gain. Okay. This ushered in a massive gain of productivity. It's deflationary. And as computers became cheaper, more and more office workers had computers, and then more and more people had computers in their home. We had a massive technology boom that gave way to a massive efficiency gain. And that, to me, is really what drove prices lower and kept them low from 1980 till about 2020. So having said all that, I think that prices in 1980, 81 inflation would have come down anyway, because eventually prices go up so much that consumers stop buying things. They start hunting for lower prices, so lower cost businesses start the process of bringing down prices, gaining more economies of scale. It's just that higher interest rates could maybe excel, speed up that process. But my own economic opinion is inflation and deflation will take care of themselves. Unless, of course, the government does something stupid like print money like the Weimar Republic. And when people say we're becoming like the Weimar Republic, we're printing too much money, it's a really dumb analogy. And it's a dumb analogy, and it doesn't work. There's nothing at all similar to what our Fed has done. I mean, printing money is not just this. It's not all printing money is created equal. So, having said that, we need an efficiency gain now to get inflation down. We don't know what it is. It could be battery operated cars, EVs, because we'll be spending less money on gas. Although the cost differential, well, as gas is going up now because oil is going up, EVs are starting to gain a more competitive advantage, although it is getting more expensive to charge an EV car. But we think, the market collectively thinks, that the next big efficiency gainer, we had computers in the 80s, and then we had network computers, also known as the internet, in the 90s, the 2000 to the 2010s. The next big thing is expected. It's the only thing we could think of is artificial intelligence. That takes the computer connectivity, puts them together, and does more than just collate and organize information in spreadsheets. It finds trends and tells you what the trends are. And we hope that maybe, or the hope is that it has some kind of predictive power, but that's the next big efficiency gainer. And we're not quite there yet. But if this is as big as the internet and the PC, I'm talking about artificial intelligence generally, that could be the next inflation killer, the next massive boom that ushers in productivity that could maybe squash inflation for another 20 to 40 years. And that's why you keep hearing about artificial intelligence. And that's why artificial intelligence related stocks have been going up, because people want to capture the next big trend. But we know with trends in the past, with the PC, Gateway Computer, Micron Computer, and plenty of other computer companies have disappeared. We know a lot of internet companies have disappeared. And I'm quite certain that a lot of artificial intelligence related stories / stocks will also disappear. We go through fads, and then we have our nuclear winter, and then the strongest ones come out of it. Will it be NVIDIA and Marvell and Advanced Micro Devices? Are those going to continue to be the leaders of the AI revolution? As far as hardware goes, we shall see. No guarantees. So that's the, I guess that's the risk when you invest in individual stocks. So we will find out. So that's one thing that we need to get inflation lower. It's not just about slowing the economy with higher interest rates. It's about something to make sure that we get more productivity out of everything we do. That's what brought it down in 1980, inflation. And I think that's what we need now. It's going to take time, and I don't think we've given it enough time. And I think the promise of artificial intelligence, it's happening, but to be on the scale like the internet is now, I just think we have to be patient. It's coming. I'm confident of that. I just can't tell you when, but I don't think it's going to be soon enough to placate impatient investors. The other thing about interest rates, we keep saying the Fed could be done raising rates. Here's the thing. When the Fed raises rates, it typically knocks the stock market down and it knocks the economy into a recession. We really haven't had those issues yet. We had a down market heading into the end of last year. We had a bit of a recovery this year in hopes that the Fed could be done raising rates, possibly lowering rates early in 2024. But we are just going back and forth with this thought process. It's not really helping anybody unless you're an active trader, in which case you're probably pretty happy with this right now. The market's recovered a lot of its losses last year. Some stocks have gone onto new highs. You know who they are, these magnificent, gigantic, super mega cap tech stocks like NVIDIA, which is $1 trillion plus valuation, Apple, Microsoft, Google, Amazon, the stocks that we talk about all the time. The problem is anyone I know who owns individual stocks owns at least two of those. That's right, at least two, because I see the people who come into me new accounts all the time. And there's always at least two of those 5 or 6 or 7 mega cap stocks in their portfolio. Plus, they're very widely held, represented in index funds, in particular the S&P 500 index. You can't invest directly into the index. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Okay, I have to always say that. So if we really want to see the Fed done raising rates and getting into rate cutting mode, we're skipping a step. And that step is recession, a real recession, not just a slowdown in the economy, and a down market. So when the Fed finally gets to cutting rates, we have a turbocharged stock market because it's recovering from a downtick. It's bouncing. And we have a turbocharged economy because it's coming out of a lull, out of a recession. Neither of those conditions exist today. And this is why typically the economy and the market don't just pick up automatically when the Fed stops raising rates. It actually has to go a little bit beyond that. And I think investors are starting to realize they're putting maybe a little too much emphasis on the short story of the Fed getting ready to stop raising rates. So if rates go up, we're down because it hurts valuations, it hurts tech stocks. If rates go down, well, that'll finally be the signal that we actually are in a recession, and the stock market we would expect would reflect a lot of that. And I just don't think the economy and the stock market are reflecting some of the key worries right now. Now, worries don't always come true. That's why they're worries, right? Worries don't necessarily come true. There's always something to worry about. So let's take a look at the board, and I'm really enjoying how the show is going today. If you would give us a thumbs up, or ask me a question about the content we're talking about, and I'd love to hear that. Okay, so let's just put this up. Okay. First thing I want to look at is the stock market is down again, down 200. So we're really starting to see the major averages start to give back some of their gains this year. NASDAQ down, S&P down. And, they're not just down a little bit. They're not down a lot, but it's starting to add up. Oil is up $1.04, almost 1%, 887.57. Yields are going up. The VIX is still kind of low. That's 14. What would be a high VIX? I'm going to say 20 or above. That's my opinion. And let's take a look at bonds. Bond yields are going up. So if these are green, it means the prices of bonds are going down. So you see bonds going down, you're seeing that go down, and you're seeing stocks go down at the same time. So this is where we like to say diversification is a strategy that we use to mitigate risk. But like I said, it doesn't necessarily prevent your portfolio from going down in a generally down market. And that's certainly the case right now. But yields, the 2-year is above 5%. When you see the 2-year yield above 5%, that attracts a lot of money. That's the magic number, 5% in the 2-year treasury bill, the 2-year bond. That's the magic number, and that's the magic number, and that's what I see as a negative for the market that seems to work almost every time in pushing stock prices down. I want to take a look at this. Okay. This is not what I want to look at. Now, we're talking about oil going up. And it's been going up, and you're seeing $4 a gallon of gas all over the place. It's not quite the national average yet, but it might even be there today. But let's just take a look. Why is it that Chevron is still 166? I feel like Chevron has been at 166 for a long time. Now, in the last 6 months, it's in a tight trading range. It's gone as high as 170, as low as 150. That's like a stock trading between 15 and 17 in the last 6 months. Not a hugely volatile number. If you're a trader, you have been buying Chevron stock at 150, you've been selling it at 170 or the high 160s, and you've been doing pretty well with that. But with the price of oil going up, why isn't Chevron going up? So I see a disconnect there. What could this disconnect be? The disconnect could be that we could be heading into a recession. So why would you bid up oil prices, oil stocks, even though the price of oil is high? Because you would expect that 6 months from now, demand is going to go down. That's the read. I'm following the two most important industrial stocks. United Rentals, when you see big deals, big earth-moving deals, big construction projects, public works projects, United Rentals does well because construction companies use and rent their big equipment from United Rentals. That's, you see by the red here at the end of this line, that's very close to its all-time high. And Caterpillar is pretty close to its all-time high. So if you look at these industrial stocks, the economy is doing well. I think a lot of this is reflected in home building, and a lot of it is because of all the the construction acts, the Infrastructure Act, and all the new construction in the chip sector. There's a lot of big construction taking place, so these companies are doing well. But that's one of the things that's holding up the economy, and that's one of the things that's keeping employment strong. And whether if the Fed raises rates or not, these acts and the spending doesn't stop. And then I want to take a look at some of the interest rates. Not this one. Let's look at this one. The 2-year spread. Okay, this is the yield curve. It's 0.73. It's negative 0.73. So that means the two-year Treasury bond is actually 0.73 higher than the 10-year. So it's still an inverted yield curve. And I think until we see that change, it's going to be very, very difficult for investors to start to get excited. That's probably not going to change until one of two things happen. We get so much more inflation that it drives up long-term bonds so that they're finally higher than short-term bonds. But if short-term bonds are 5%, that means we'd have to see long-term bonds go up to 5.5% or 6% or even more. Imagine what that would do to the economy, and imagine how hot the economy would have to be, how strong inflation would have to be for that to happen. Or we go into a recession and the Fed starts to cut rates, so maybe long-term rates go down a little bit, but the Fed brings down the 5% rates and short-term treasuries all the way back down to, let's say, 2 or 3%. That's why this is such a tough market to read. And that's why when you have this kind of uncertainty, that's why the market's acting so tough right now. It's so tough to get a gauge for any direction because investors are just so darn confused. And the case for an up market, strong economy, down market, down economy, the case for both are very, very compelling. And we just haven't been able to figure out one way or another which way that's going to go. But we do switch between those points of view seemingly every couple of weeks. And I think it's making investors a little gun shy, and it's making more people want to sit on the sideline. Okay, that's about it. Thank you so much for watching, and I'll be back tomorrow.